Welcome to RenMac Off Script, where we're able to discuss markets, economics, policy, history, and life. It's the 22nd of September, 2023. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our LinkedIn page. And if you're listening, but you're not an institutional client, but keeping up with the latest market-moving developments is important, and again, why else would you be listening? Then we have a site for you. It's called RenMac Access. That's renmacaccess.com. It's a site that we've designed to give RIAs and intelligent investors the insight to ideas and topics that we're discussing here. Again, that's renmacaccess.com. Steve, we're looming government shutdown here in about a week. What do you think are the primary sticking points? And if it looks like it's a fait accompli, but what do you think the duration is on something like this? I get that it's a tactical move, but what's the willingness to hold out, and what do you see this as part of the duration play?
Well, I think there's the risk that it could actually be longer than many people are anticipating, going beyond a week into longer, because I think we've discussed before, political rationale for some on the right to shut it down to insulate themselves from a potential primary threat. However, I don't really see what the political fig leaf is to sort of change your vote to reopen it. It's not clear. Usually when you sort of threaten a shutdown, you're trying to get some policy concession. At this point, I'm not really sure what that's going to be. You have a lot of sticking points. I know that a lot of attention was paid yesterday to Ukraine President Volodymyr Zelensky's visit to the White House. He wouldn't be to Capitol Hill, probably more importantly, just because he needs to persuade skeptical Republican lawmakers to continue to support the war. I think the fact that you look at a very different reception he received this time compared to in December of last year when he got a standing ovation. You can debate whether or not you're throwing good money after bad in terms of what has been the return on investment, what's the strategy. I think there are a lot of reasonable questions to be asked with the funding, but that's going to be a contentious point. And then what do you do if you're House Speaker Kevin McCarthy? If Democrats in the Senate with some Republican support can send over a clean CR, continuing resolution, will McCarthy at some point bring that up and pass it with a majority of Democrat support? If he does that, then he potentially faces an existential threat to his speakership. I'm not sure how real that threat is, because it's difficult to beat somebody with nobody. I don't know who would want the job if I was a House Republican. But again, that's something he's going to have to consider moving forward. But I think what he sort of anticipates, to your earlier point, just to reemphasize, is if the government shuts down, he's less confident as to what those who are voting for it need to reopen it.
Can you deal with the Senate with nothing? I mean, do the conservatives on the House actually understand that?
I think there's some question as to you have a lot of newer members, I would say newer in terms of the last two election cycles, that haven't been in the majority before. So there could be an education issue as to, you're no longer in the minority. We can sort of just oppose things on principle. You actually have to govern. And there could be an education process that's going on between Speaker Kevin McCarthy and these newer members. But you get into some pretty fundamental disagreements over things. And even if we reopen the government, a lot of these spending divides are going to remain. So there's a very conceivable possibility we may shut it down again, or we'll get to the point when we get to December where you're going to see potentially a continuing resolution across the board into next year with a 1% cut across the board. So that's sort of the options right now, bleak or worse.
I love principled politicians. Fantastic. Just like clients love principled, or attorneys love principled clients.
If they shut the government down, presumably they slow the economy, which means revenues to the government from the private sector drives up, which then will further exacerbate the deficits that they say they hate.
Well, to your point there, Neil, if they slow the economy down, they feel that might actually be politically advantageous in 2024 if voters associate that blame with Biden more than them.
I mean, I think it's just smarter just to win elections and then get more of your people into DC and then change policies that way.
That goes back to the perverse political incentives where your greater electoral threat is from the primary opponent as opposed to the general election.
So the big thing from your week, Neil, presuming it's the Fed and their statement. What did we get out of the Fed? What did we learn this week?
Well, I think the Fed did what more or less what I expected them to. What I was more surprised by, frankly, was the market reaction to what the Fed did. The Fed revised up their growth expectations. They took down unemployment, and as a result, they erased a couple of the rate cuts that they had penciled in for 2024, which makes sense, right? So it's the Fed is signaling a higher for longer interest rate stance, but they're also signaling that's a function of stronger growth expectations. So, and I think the markets are focusing on the higher for longer and not focusing on the why. So I wouldn't describe it necessarily as a very hawkish Fed. I would say that this is a Fed that is following the data. And if they take their growth forecast down or their inflation forecasts down, then they'll be more likely to accommodate. It's important to kind of look at these things a little bit more holistically. Yes, the rates projections moved up, and if you look at that on its own, it's hawkish. But when you look at why they did what they did, it's in response to a stronger economy, and I think that's something for people to keep in mind, particularly in the equity markets. The other thing I would say is, to me, it's highly unlikely at this point that the Fed is going to be hiking in December. The reason I say that is because, first, I think about 12 of the officials see one more hike and 7 don't. And then you have many more that expect a cut in 2024. So if you think about the Fed as a consensus building institution, I mean, you think about the Bank of England this week, they had a 5-4 decision to hold, right? You don't get decisions like that out of the Fed, like those sort of close nail biter calls. Those don't happen, right? They kind of hash it out in the meeting and they try to come to a consensus and show a unified front in the statement. That's typically what happens. So you get very few dissents typically. At any rate, if you think about this as a compromising institution, I think what's likely is they're not going to hike, so the hawks won't get what they want. There are just too many people thinking that there'll be cuts soon for that to happen. So what's more likely is they don't do anything, and they kind of do what they did in the last meeting, which is signal that there are going to be fewer cuts going forward, right? So you don't actually hike the policy rate, but what you do is push back on cuts. That's a de facto tightening, considering where the markets are priced.
Right, where the consensus is and what the expectations are, without question. Well, I think what's interesting, I mean, obviously the markets are now testing that support level for us, which is 43.28. But two important things to watch historically, and they're not perfect by any means, but they're things that we do watch, which is at what point does the Fed go too far? And one of the things that you find, again, not perfect, but it's certainly worth noting, it's something that we watch, which is Fed raises rates, 2-year yield might go up for a week, and then the 2-year yield starts to come down pretty dramatically. And the idea is that the market starts to perceive that the Fed has overstepped their boundary. We're not seeing that. The other is that triple B spreads start to rise because the implications are that the economy is slowing aggressively and the default risks start to grow. And we're not seeing that either. So this decline that we're seeing in equities, not yet oversold, not yet capitulative, not yet some of these factors that we look for to suggest that we're at some type of interim low, we're still in an uptrend that will make an oversold condition viable. But I don't think it's the big one. I don't think that this is the point where things unravel because we're not seeing that rise in triple B spread. We're not seeing that contraction in the 2-year yield. We're not seeing some of these things that would otherwise be more problematic for equity. Watch copper, obviously, which is not acting that well, but oil is still on the ascent, and that will be late. So I don't want to use that as a proxy, but certainly it still feels as if things are chugging along well enough to be supportive for not only the economy, but therefore the equity market. So no capitulation from us. We're still not seeing the oversold condition. I think the oversold condition will be viable. I do think that we'll break through that support at 43.28 on our way to the 200-day moving average. And I think that's probably the next reasonable support level that will start to temper this decline. Keep in mind, seasonality starts to improve in the next couple of weeks. So we're very close to the nadir in terms of forward returns for seasonality as we cross ourselves into October. That's where you tend to see these historic bottoms. So we'll watch that as we go. Steve, I think former President Trump has a trip planned, and not to prison yet. That trip is to my great state, which is actually where I'm in right now, the state of Michigan. Is he going to be the first one to address the UAW?
Well, in terms of presidential candidates, I think that's probably accurate. You're right. I mean, he will be holding a competing event during the time where the other Republican nominees will be having their second debate. It'll be interesting to see who qualifies for that, who doesn't. I think the fact that Trump is going to Michigan says a number of things. It suggests that he is very comfortable with his position in the primary, and he's gearing more towards general election campaign. You probably got some whiff of that during his recent NBC interview when he took a more moderate stance on the abortion issue compared to where he was in 2016. I think he's trying to go ahead with respect to Michigan, make a play there. You have this UAW strike going on. He's somebody who has worked previously with unions. He really sees an opportunity to drive a wedge there between Biden, who's conflicted between his green energy transition and his need for blue collar support in critical states like Michigan. That state has flipped very narrowly. Went for Biden in 2020. It went for Trump in 2016.
Are you sure?
I'm
Well,
not.
I
I'm not
I
going to
say
touch
that
that one.
I say
Just
that kiddingly, but
because
I will tell you, between the airport and my hotel, there had to be 10 yards that were, to call it decorated with Trump paraphernalia is an understatement. I mean, this is Trump country.
did you see any Biden signs?
No, come on.
The only reason I ask is that was something I think people missed in 2016. That in hindsight, people should have maybe put a little more attention to.
Yeah, no, there was nothing even close. So,
Wouldn't you
what do
expect
you?
that though, right? I mean, because
Well, yeah,
Trump's base is more outwardly pro-Trump. I mean, nobody loves Biden. Most of the people that voted for him, did so as a protest vote against Trump. But at any rate, yeah. I'm going to be watching the UAW stuff too. I mean, because at the rate, the UAW in some respects kind of reminds me of the House Freedom Caucus. A bunch of people that don't really know what they want. At least in the UAW's case, they might be negotiating themselves out of a job. In the House Freedom Caucus case, given the political dynamics that are set up, they'd be negotiating their colleagues out of one, because the only reason they have any power to begin with is because of Republicans not in deep red districts, but in places like New York, New Jersey, Orange County, California.
But just to be fair to the Freedom Caucus folks, would you rather have a job as a member and potentially be in the minority, or would you rather be in the majority and lose your seat potentially to a primary opponent? I mean, that's sort of how they're thinking. I'm not justifying it. I'm just saying that is.
Well, I mean, I'd get into politics. I think in an ideal world, you get into politics not to score points on Twitter with viral clips, but to actually get things done that you campaigned on. One of the shocking things about representative constitutional republic is, my goodness, you actually have to get along with people that politically don't agree with you. It's the same thing with the UAW. Sometimes you got to take half a loaf. And anyway.
Well, I guess, could I just ask, Neil, if you get to a point where we have a shutdown, we have a strike, we have the student loan resumption, we have high gas prices, are all those things collectively trouble?
Well, the student loan one is an interesting one because a lot of those payments have been remade already. People that have a lot of student debt, believe it or not, they also have reasonably strong liquidity positions because there is a premium to higher education. They've been paying it back. I mean, so that's happened in advance of the deadline. Interestingly, you mentioned gasoline prices. Gasoline prices may actually moderate a little bit in the coming weeks because we have noticed that crack spreads have been declining, right? So refining margins have been coming in. So even though crude oil prices have been going up, if you look at wholesale gasoline futures, they haven't been going up nearly as much. In fact, they're down relative to where they peaked in August. So that's going to bleed into what people pay at the pump. The UAW strike, I mean, no, that is an issue. And, I think like the shutdown, it would probably be inflationary. Right. I mean, because government, in the same way that government services aren't done, but they're still paid. Right. That's inflationary for something like the GDP price index. If you're not building cars and the supply chains get more screwed up, that won't be good for car prices, particularly at a time when inventories remain pretty thin. The good news is that there's a decent amount of forward momentum in the economy, and it's relatively well understood by people in the marketplace. I mean, we talked about it last week, right? The 3 S's: shutdown, strike, and student loans. And I think, as what's less well understood is why the economy can hang in there. So that's sort of how the money's made in the markets, right? Is not to point out what everyone's already talking about, but kind of look around the corner to see what they're not talking about.
Looking around the corner. And that, in our view, will be the triple B spreads as we go. Such an easy indication, not well understood or certainly appreciated in the marketplace. Neil, in terms of next week, what is happening that you're keeping an eye on?
So we'll get data on durable goods, which I think will be important. We also get data on consumer confidence, the conference board data. I'll be keeping a close eye on that because, we did see the labor differential crack in the last report, so it'll be interesting to get an update on that. And then we get the core PCE inflation data towards the end of the week, and that's important because, as we've been pointing out, there is sort of a widening wedge between CPI, which is what comes out first. The markets tend to respond more to it, and PCE. Remember, there's in economics we have different measures that measure the same concept, right? Gross domestic product versus gross domestic income. PCE versus CPI. This is one of the things, you get sort of a different kind of ways to sort of skin the cat. But right now it looks like PCE, which is the Fed's preferred measure, is not rising as quickly as CPI. The hope would be that it would, be another reason to take a little pressure off the Fed in terms of hawkishness.
Yeah, well, obviously we'll be watching those yields. We'll be watching real yields as they punch through 2%. That becomes more problematic for equities historically. We'll watch those triple B spreads, and then we'll watch these levels. The 200-day moving average ascending will be an important level of support, and looking at that with oversold conditions, both the percentage of issues above the 20-day moving average, the RenMac indicator, the RenMac oscillator, will be important as we get down below that -3 level, and we'll keep you apprised to that as it takes place in our daily work. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you want deeper insight, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.
Thank you.